is paying the loans that it has or not. This is hard data, right? And they tell you, yes, the firm is paying all the loans, so that's fine. Then you take your decision. But if you go to the Banco España web page, you don't have a mortgage, right? But suppose that you have a loan and you introduce your fiscal identifier, you can download your information from here. And this is hard data. You go to the bank and you say, look, I have a lot of loans, but I'm paying all of them. So this is hard data. It can be measured and it cannot be loose and it can be transmitted very easily, right? So you can say to the bank, look, I went to the Banco de España, they give me the data, and I'm paying on my debts. That's fine. And as I was saying, it does not depend on the context. So this data, of course, I mean, if the context is worse, suppose that you're in a financial crisis, the financial statements, the debt that you have, of course, are going to be probably worse, but this hard data can be measured no matter what. So the firm reports the financial statements to the trade registry and the information is there. So it doesn't matter whether the manager is sick. You know, there are a lot of papers showing what happens with the firms that are listed when the top managers are sick, no? And they see that there is a drop in the prices. So this is different. So this is something that does not depend on the context. It will depend on the context probably in the future, but up to now, when I see the data, that's what I can see. And there are samples here. So you know what the credit bureau is? The credit bureau is it's very similar to this. That's why I wrote this. This is the credit registry of the Banco de España. All countries have the credit registry, public credit registry, in which here all the loans that are granted by a bank to firms are collected here. So I have in the data that we have at the Banco de España, we have all the companies in Spain, all the loans they have with all the characteristics, and the same for the households. And you can see anything from there. This is the same, but this is a private one. So they collect information from borrowers, and there is a company that puts everything together, and from there they can obtain this figure here that is like a rating for the borrower. Yeah, so.
I mean, I have credit in the States and you have a FICO score, right? And that kind of tells someone, you can self-evaluate how you're doing in terms of credit. And Spain has something similar. Can I see my credit score?
No, for households, we don't have a credit score. I mean, banks would have their own credit score, right? That's different. But what I mean is that in this data set, in this, let's say, central risk management database, there is not a credit score for households. So you only see whether you are paying your debts or not. This is different, and the US is the same as I was referring here to the credit bureau. In the US, you have this figure here is the credit score. But for companies, the banks, you know that Herman explained, there are two types of banks. The one that have the internal rating models, and the other ones that have the standardized models. So the banks that have this type of model also report to the Banco de España the probability of default of the firm, because they have their own models, and they have to report this information. The ones that have the standard models, they don't need to report the probability of default of the firm, but of course internally they have this, right? But this is not public for anybody, so nobody can ask the Banco de España and say, look, can I see my credit score or my rating? But what you said is very important, because what they are trying to do now is something related to that. So we are considering whether we should make public the probabilities of default that the Banco de España estimates for firms. And this is very important, because there are very small firms that they don't have a rating, they don't know the probability of default. And what we are considering now is whether Banco de España, given that we have a whole division that is measuring the ratings and the probability of defaults of the firms, whether it should be given to the firm, as you were saying. And it's positive because it, in some sense, cuts problems of asymmetric information. So we are moving to that, but it's not the same as in the US.
So in terms of the credit ratings, I don't know much about the market here. So in the States, for instance, whether you're a company or a household, you know based on your score what type of credit you can ask for, even like what institution would take your credit based on your current score. So I know it's not public, but internally, how those does Santander have a different benchmark to give credit to companies that probably smaller bank that's going to take a high risk for companies that are not that big?
So there are two things here. So one is households and companies. They are also very different in Spain. No? Households. banks would have their own models in the sense that you go to the bank, you ask for a mortgage, and they ask you your income, your wealth, blah blah blah, and then they assign the internal rating for you. You don't see this rating. They tell you whether the mortgage is granted or not. And then for households, there is a second thing that are these borrower-based measures that I was saying. In the sense that in Spain, we don't have borrower-based measures. But in other European countries, such as Portugal, they have borrower-based measures. What does it mean? It means that you have a limit in terms of the loan-to-value. You know what the loan-to-value is? Loan-to-value or loan-to-price? This is the size of the loan relative to the value or the price of the house. Okay? So in Portugal, the more similar thing in Europe to what you are saying is you have this limit. So if the loan to value is above 80% or 90%, the bank is not going to give you the loan by law. But even in that case, there are some exceptions. For instance, for young households, they could reach 90%, right? And these are for households, these are the specific rules that we have in Europe, the borrower-based measures, no? The loan to value and the loan to income, these ones. Loan to income is the loan relative to the income of the house, of the household, sorry. Loan to income. So if the loan to income is, let's say, higher than 40%, in some countries, the bank cannot give you the loan, right? Because it means that the risk is above a given threshold. But it's not a specific rating for a household. So there are independent measures in some sense that are related to the risk that determines this. So the larger the loan to income or the larger the loan to value, the larger is the probability of default of the households.
The higher is the, sorry, can you repeat that?
The larger is the loan to income, the size of the loan relative to the income of the household, or the loan to value, the higher is the probability of default of the household. Right? So I have a paper on the loan to income. So what happens if the interest rates associated to the mortgage are floating? So it means that during a tightening of monetary policy, in which the interest rate is growing a lot, the amount of money that I have to pay for the mortgage is increasing. And there is a point in which I cannot survive. So we produced in the Banco de España in the last elections something about this, and in the debate, when the two political leaders were discussing about this, they referred to our report because there we were measuring, once you consider the amount of money that you need to spend in the let's say, in food, in the basic services, whatever, what is the money that you have to survive? So if you have a floating rate loan and the monthly payment that you have to do increases over time, at some point you are not going to be able to pay the mortgage. And so the larger it is, the larger is the probability of default. This is for households. For companies, the big ones in Spain, they have the rating. But in Spain we have 100 companies that issue bonds. So the other ones don't have rating. And then you have some, as I was saying, for the banks, you have the internal rating models and they measure the risk with their models. But this is not public. And I was saying, what we are considering now, this is something that is under discussion, is to make this risk for firms, not for households, because in Spain for households there is a lot of issue with confidentiality. So for instance, in the credit registry, I don't see which is the fiscal identifier of the household, but I see the fiscal identifier of the firm. It's not like in Norway or North Europe. There you can see everything about every household, right? So here is different. But for companies, we are there in the sense that the banks for companies have very good risk measures, but they are not public. If there was public measure, it would be very easy, especially for small firms, to have access to credit. And in terms of what I was saying there, at the informational asymmetries, it would reduce. Okay?
Is that only 100 firms have information?
No, only 100 firms in Spain issue bonds. So you know that you only need the rating when you are a bond issuer. So if you are not a bond issuer, you need a rating. Right? So this is the only public information. In terms of risk, we have also, the credit default swaps. You know about it, no? But again, the credit default swap is a measure of risk that is given by the market, and we have this for around 20 firms in Spain. Sorry.
Yeah, I was going to ask a question. What's the difference between PICO and agencies like Consumer Union Experience or Equifax? Like, what would be the difference between PICO and Equifax, TransUnion?
No, I think they are credit bureaus, right? And they have their own rating or their own measure of risk. So PICO, as far as you know, I'm not an expert in the United States, but this it's just a measure of risk given by a credit bureau. And there are different types of credit bureau, and honestly I don't know how they work or how they measure risk. But I just want to say that this is a measure of risk by a credit bureau, that is a private special case of this public credit registry that we have in Spain. So the point is that here I was into income and balance sheet ratios for the firms and also for the households, right? The loan to income and the loan to value. This is hard data. And also the collateral appraisal. Do you know what is an appraisal company? No? You know it.
It's the value to an asset.
Exactly. But the point is that these appraisal companies, right, are the ones that give the value of the collateral. I have a paper on this if you are interested in which I was measuring. In Spain, the appraisal companies were connected to banks.
Yeah, makes sense.
And in terms of regulation, there is a threshold, right? So if the loan to value was above 80%, Germán explained about the risk weights, no?
Yeah.
The risk weight was 100%, but if the loan to value was below 80%, the risk weight was 35%. And you can imagine what happens, no? So the institution that is given the value of this housing is the appraisal company that is connected to me.
The appraisal company, can you give what the appraisal company?
The appraisal company, when you buy a house, the appraisal company is the company that says the value of this house is whatever.
Or you pay the impuesto de renta?
No, this is different. You pay the impuesto, the taxes, depending on the real price that you pay.
Okay.
That's the key. But for regulation, what matters is the value of the house that the appraisal company is giving to you.
Ah, that's where you do ask for the credit.
Exactly.
And it renews every year, I guess.
No, I mean, when you buy the house, I mean, you can have an appraisal valuation of your house whenever you want. The issue is that when you buy a house, you need it once. And then you go to the bank. In many cases, it's the bank, the one that sends the appraisal company to your house to see the price.
Okay.
And then the bank tells you, look, you're asking me for a loan of 100. But according to the appraisal company, the value of the house is 90, so I cannot give you this. Then I can give you 80% of the value that the company is giving.
And the appraisal companies are all of them private?
They are private.
Okay.
They are private. They are private, now they are independent. In the past, they were owned by banks.
Okay.
So can you explain, because I barely see what you just wrote.
Sorry. Probably I can move the...
Can you raise that thing instead? Let me see.
See?
Sergio,
Yeah.
can you raise that thing so you can write on the board behind it?
I can do it.
Yes.
I think so. Here.
Yeah, that's a board, I think.
Behind them, there's a board.
No, but you,
I think there's a controller in the
Okay, but then I need to go back every time, so...
You do? I mean,
Because I need to right here, so when I want to solve this again...
no, but it is still going to display the light, so this doesn't matter.
Okay, sorry. Now I understand.
Yes.
You know, last time I was teaching, I started to write the so it's just like this. It's not perfect, but yeah. Okay? Does it work for you?
Yeah.
Okay. So you were asking about this, no?
I was asking because I couldn't see, so I didn't follow you.
So this is the loan to value, loan to income, and I'm referring here to this 80%, which is the loan to value threshold that determines whether the risk weight for a mortgage is 100% or 35%. So my point is, I'm a bank. The appraisal company is connected to me. You buy a house. If the price of the house, let's say, is 100, and you are asking me for 90. If I give you the loan by 90, the risk weight of this loan is going to be 100%. So if I'm the appraisal company, what should I say? It's not 100, it's 120. And then the risk weight for the bank is 35%.
So for here, the real estate companies are not considered banks because I know like
They were.
there was an issue in some countries where some real estate companies were connected to banks.
They were.
So the credit appraisals will praise the value at the price they wanted to sell the property for because it was brand new.
Exactly.
And that created a bubble that inflated prices.
They were connected to, somehow connected. It's not that the banks were the owners of the company, but they were somehow connected. But in the end, if there is an agreement between the bank and the real estate developer, and I'm the one that is offering the financing for the households that are buying this, look, we are not connected. But in the end, you are my main client, or I'm your main bank. So exactly, and the same happens with the appraisal companies. What I wanted to say with the appraisal companies is that in many cases with these appraisal companies, what happens is that, not now, because now the Banco de España is in charge of the supervision of these appraisal companies, and it didn't happen. But in the past, when the appraisal company was of the bank was saying increase the value of the house, such as the loan to value is going to be lower, I can give the loan to this person, and on top of that, the risk weight is going to be 35%. Okay? But again, I mean, it's hard data. You can believe the data or not, but it's hard data, right? What I mean is that with all this data, you can put the data in a model and you can take a rating, right? Okay, so hard information, right? What I wanted to say here is, why is this important? So what is the role? I mean, it's very easy, because if I just take decisions based on hard data, what you were saying, right? Well, in the United States, I ask for a loan, the bank check which is my score, and you give me the loan or not. I don't need to do anything else, right? So in some cases, it's good in order to develop credit markets, because it's information that you can check very easily, but there are some risks, as I will show you later. So the point is that this is very simple, no? You calculate the risk score, or you offer me the risk score, or the rating, and then I decide whether I give you the loan or not, right? Regarding this borrower-based method. So if you tell me that the limit of the loan to income is 40%, or the limit of the loan to value is 80%, if you are above, I don't give you the loan. It's very simple. So you can tell me, yeah, but you know, I have this job, in 2 months I'm going to be hired by a good company and the salary is going to double. I don't care, this is soft information. According to hard information, this is the risk, and it gives you the normal. So what is important is that it's very easy to grant loans, as I was saying here, and if you focus debt to income ratios, not that the one that I was referring here, or loan to value ratio, so it's very simple for the mortgages, and also when you securitize the mortgages, you know what a securitization is now? No? So the idea of the securitization is, you have a loan. Who grants the loan? The bank, no? And then what happens is, the loan is sold to a special purpose vehicle, and they convert all the loans of the bank. Suppose that the bank has like N loans in a single bond, and this bond is sold to the market. So this is a traditional securitization. What happens for the bank? The bank has N loans. I put together the N loans. I sell the loans. They convert it in a bond, and it's sold to the market.
It's a portfolio of loans.
It's a portfolio of loans. The securitization consists of a portfolio of loans. What happens is the bank receives, let's say, this is the bank, no? The bank sells the loans and the bank receives the cash. And with this cash, they can generate new loans. Yeah, questions?
Does this have something to do with the 2008 crisis?
Yeah.
What was the name of those?
There were mainly the collateralized debt obligations and collateralized loan obligations.
I suppose the difference. What's the difference between the one and?
Well, the main difference is that, you know, they were called the subprime, because you have two types of clients, no? You have, the clients can be prime or subprime, right? So prime client means that they have a good loan to income, good loan to value, good risk, whatever. So what happened in the US and in Europe as well is that it was a very opaque bond. So banks put loans there, but many of them were granted to subprime clients. So I transfer the loan to this vehicle, and then I start lending. So the loans that the banks were transferring to this vehicle were very risky loans, were the subprime loans. What happens is that there were many people in the market buying this bond, and they didn't know what they were buying. I don't know if you have seen this movie. What's the name?
They started like first prime, they started then mixing subprime with prime.
I do remember the movie. No? The issue is that there is a person that starts to see the loans, these individual loans that were behind the bond. And then this person sees that the bonds are very risky, and the person says, look, what I'm going to do is to buy protection against this. So if they default, I get very rich. And then they go to a company in order to buy a credit default swap, right? A credit default swap is similar to a collateralized debt obligation, and the bank says, you're crazy, I mean, are you going to pay this for that? And he knew the risk of these loans, and they say, no, I'm going to pay this. You know what a credit default swap is? No. Credit default swap is a case in which suppose that you have a bond, and the bond is risky, right? And then you buy a credit default swap. So if the bond defaults, this is like an insurance, no? You get the notional of the bond. So it's like an insurance of a house, right? It's the same. So what happened during the crisis is this, no? And I was referring to this because thanks to this, if you securitize loans, if the loans are good, you can say, look, I securitize these loans, the loan to income is good, the loan to value is good, and probably investors are going to buy these bonds because I know that the loans are good. But I mean, your point is very good. This happened in the past. Now in Europe, I give you an idea of data sets that are almost free. So now in Europe, after the crisis, there was a company that is called European Data Warehouse. You can check the data, there is a lot of information there. So I work for free to them. I give them advice in some cases, right? And I use this data. They give me the data for free. So in this company, you have information on all the securitizations. You see for each securitization the pool of loans that are part of the securitization. All of them. All the individual loans. So you don't see the name of the family, but you see the income, the zip code in which they live, the risk. There, I mean, going back to your point, there they have a kind of rating. They have a figure in this data set. But it's something that they generate. Okay? And thanks to this, if a bond of this want to be used as collateral at the ECB, you know, the ECB provides financing to financial corporations, and they use bonds as collateral. Okay, you give me the loan as collateral, and they give you the money. So if a company wants to put these bonds as collateral in the ECB, they need to fulfill with this criteria, which is the 100% transparency, in the sense that I know all the individual loans that are part of this securitization. And going back to your point, what is happening now with banks? What are they doing? If you see what are they securitizing, they are securitizing good assets. Because I don't want that anybody sees that I'm securitizing bad loans and that they default. Okay? And I have a paper on this, and the point is, when they securitize, it's related to the class today. They have two clients. One with a lot of relations in lending, a client that they know very well, and clients that they don't know. When they know a client very well, the loans of this client that they securitize are loans with an age of 3 months. In the sense, I know it could be longer, that's fine. When they don't know the client, again, relationship lending, they securitize loans in some cases with an age of 1 year. So it's not that they grant the loan and they securitize. They see that the loan is paying well, and then they securitize. That's why the risk now is very different. Okay? In the past, nobody knew the risk. So if you see the evolution of this, there are some indices, and you see that the price was 100, and suddenly it dropped because of this. But apparently they were very safe. Okay? Okay, so the cost and scalability. I mean, it can be quantified, and then you can say your boss that this is the risk of this person, and you scale up the risk of the person of the company to your boss, and then decide what to do. No? And again, I mean, I was saying that in the end they are very personal decisions, and it's positive for securitization because I know I have all the information on this person. And here I was saying the same. No? The financial ratio, the score, all of them have this. I want to go to the papers, right? Because there is a lot of theory here. It also facilitates secondary markets. This is what I was saying about securitization. So it's easier to sell a loan if I have good hard data on this loan. So if I know information on the loan to value, loan to income, whatever, and what I was saying there, and the credit score, I use good data, and then it's easier for me to take this loan and to put it in a securitization because the market knows that the quality of this is good or bad, but at least I can see what is there. No? And here is your question. So you were in advance. So this is what I was saying. Right? The point is, it's not that in the 2008 crisis there was not hard data on these loans. There was hard data. The point is that the hard data sometimes could have some mistakes or problems.
So, I understand the whole bulk of what happened to me, 2008. My question is on there's created agencies that rate bonds here in Spain as well, I assume, right?
Well, in Spain we have some credit rating agencies, but they are very small, and they provide ratings for medium-sized companies, right? And this is a good place to work. I mean, I just give you ideas. One of them is Inbonis. I don't know if the name is like that. Probably it's with Latin, I don't remember, something like that. So we have some small rating agencies in Spain. Accessor, I think that is another one. But they mainly provide ratings for medium-sized companies. So, and they cannot compete with the Standard & Poor's or Moody's or whatever. So they focus on companies that are smaller.
But that was one of the issues as well with the crisis.
But the issue with the rating agencies is that they didn't know what they were doing. And in many cases, there was something that is called rating shopping. You know what is this, no? I mean, one of the last things that I did here at the university, in the same master, there was a student that, I don't know if it was this master or the one in I don't know. So we did a master thesis on rating shopping. Rating shopping is, I'm a rating agency, and I'm providing ratings to you. But your name was Jesus, no?
Yes.
Jesus has 2 bonds. He has 2 bonds. Your name was? Alex. Alex has 100 bonds. You have the same risk. How can I see your risk? Checking the CDS. So I go to the credit default swap, and I see that your spread is 50 and yours is 50. The only difference is that with rating agency, who pays for the rating? The investor or the company that asks for the rating?
The company itself.
The company that asks for the rating.
They can bribe the agency, the credit rating.
Exactly, but you have 2 bonds. So I know that you are paying me fees for 2 bonds that you have issued. And Alex has 100 bonds. And he's paying me fees for 100 bonds. So if I have to decide who is going to get a better rating, Alex. Right? And this is something that happened during the crisis. So I mean, rating agencies, it's difficult for them. I mean, someone told me in the UK, no? You go to London and many people go into the rating agencies, the good ones go to the private banks, to the investment banks. So it's not that they pay so much, right? So it's like securities exchange commissions. So they always go, behind the market. The market pays much more. There are much more people. I mean, it's difficult to think that. How many people work in the Securities and Exchange Commission in Spain? 500 people. Do you think that these 500 people with the software they have, the computer they have, the data they have, are going to be able to follow the market? Of course, I mean, it's something very different. And that's what happened also with rating agencies. I'm not saying that they did it intentionally. What I'm saying is a mix of not being able to do this plus this rating shopping. There was a conference in Venice. It was when the Lehman Brothers collapsed. You remember, no? 2008. I was in a conference in Venice that was about CDOs, so pricing of CDOs. It was the same day, during the dinner of the conference, right? And the funny thing is that there were supposed 10 papers in the conference pricing CDOs, and the 10 papers were given different numbers. And then at that moment I thought, look, how is it possible that they give one say 50, the other says 70? All of them have good reasons. I'm not saying who is the best or the worst. But you can see that it's very difficult to measure the risk at that moment. And these instruments disappear from the market. Nobody will take a position on this. I have a colleague that was doing the PhD. You asked me about how long. So the 5th year in the PhD pricing this, and suddenly he was pricing here. Right? So I'm not saying that there is a bad intention in this company. And the other thing of hard data that Herman explained is that this is very useful for regulation. So when you see what happens in regulation, so in Basel and all the committees, they ask for hard data. So you need to provide a rating, you need to provide the collateral in the loan, you need to provide everything, right? So that's why hard information is very important. And then I go to the papers. But what happens with the hard data? That we cannot price it. Up to now it's very nice. It's very simple. I know the risk, I give the loan or not, depending on that. but you cannot provide, for instance, price the effort of the borrower. So suppose you go to the bank, you sit down in front of the officer and you say, look, I'm going to put all my effort, I promise you that this is soft. I mean, if I know you because I don't know, I know you from the school, whatever, then probably I can trust you. Of course, there is a risk from the side of the officer, but this information cannot be priced with the ratings or with the score. And that's why hard information is not right. And then another thing that you were mentioning during your points. So the misrepresentation of risk. So hard data is not always perfect. You refer to rating agencies. This is one example. We were referring to appraisal companies. This is another example. In this case, this is intentional. But there are some cases in which we cannot believe, in some sense, hard data. Sometimes there are typos, there is problems, and sometimes the firm itself is willing to lie to the bank, right? So, what did you risk? I'm checking your financial statements. Who is submitting the financial statements of the companies to the trade register? The firms, right? And this is the way in which the firms, in some sense, can modify the financial statements. And if we over-rely on these ratios, for instance, as you were saying before, no? The credit ratings. I mean, we consider that what is in the credit rating is perfect, so probably we can take bad decision if the information is wrong. Again, sometimes it's intentional and sometimes it's not. So I don't know if Herman explained you about this paper that we have. Okay, so perfect. This is about how important it is to consider information. This is a paper done with Herman and also with Maria, Maria will be teaching the empirical part, no? The part referred to the systemic risk, to obtain a value risk with bank data, bank balances, and so on. So she will come in the message. And this is a paper that we did in order to measure misreporting. And this is very interesting. Again, I mean, I will explain the paper. Interrupt me at any point. I will explain the data that we use, the methodology, whatever, how to think about how to write a master thesis or a paper. I mean, this is for this. This is the useful thing. I give you the theory, but I use examples of my papers to give you some additional evidence and some additional information on this. Okay, so the point is, banks use this information. So banks, you go to a bank for a loan, and then they use this hard data in order to decide whether I give you the loan. Which means that banks are very interested in having good data, good hard data. So I want that the financial statements that the firms provide to the trade registry, that they are good, because I'm going to use this data. But, on the other hand, banks also get a lot of information and a lot of money when something is not clear. So suppose that I know a firm quite well. I have a strong relationship with the firm. And I know that this information probably is not right. But this is not something that I know. The other banks, the banks that are potentially lending to them, they are totally lost, and I have this information. So probably I'm not very interested in having the firm providing the reports properly. So there is a negative side and a positive side. On the one hand, I use the data, so banks want that the data are good quality. But on the other hand, if they know the firm quite well, they could have, in some sense, some incentives, right, to exploit this private information. Okay, so what we find in the paper is the firms we report. And we started this paper, you know Pescanova? The Spanish ones know Pescanova, no? Okay. So, you know what happened with Pescanova, no? You don't remember. So the issue is that someone merged the information from Pescanova that was in the credit registry with information of Pescanova that was reported in the financial statements. And they discovered that the amount of debt that Pescanova, listed company, audited, that the financial debt that Pescanova had in the credit registry, the real one, the one that the banks provide, was 6 times larger than the debt that Pescanova had in the financial statements. Okay, so we are using hard data, fine, we are using hard data, but the hard data could be wrong. Okay, that's what I wanted to show in this paper. And why could be Pescanova interested in reporting this information back to the banks?
They don't want the people to know they are over leveraged.
But what people?
The the investors?
Well, the investors fine, they know it, they can say, look, I buy or I buy, but in the end, they are going to banks. And in the judge, because there was a prosecution on this, someone working in a bank was asked, why didn't you check the credit register? And all the information was here. And she said, I forgot. So it was free. It was free. This person only had to check. Let's see whether the information of Pescanova is good or not. And they didn't do it. So
the person in the line said.
the person in the private bank,
Okay.
they went, I will show you what happened there. So the point is, I mean, they didn't check information properly. Right? Of course, there is a problem with the person working in the bank. But why Pescanova wanted to do this? Because they wanted to obtain a loan. So if I want to obtain a loan, I'm going to lie, I'm going to see that my debt is lower, right? I'm going to use anything to look pretty to the bank, but in the end, I'm not. So if the bank doesn't check the credit registry, then I get the loan. And that is. And suppose that they see that I'm lying. If you are Pescanova, I mean, I'm saying Pescanova, I hope nobody has any connection with Pescanova. What is the next thing that you are going to do if the bank doesn't give you the loan? You go to a new bank and do this. That's the point. So what we do with this paper is, this happens with hard data, but banks are very important because banks can discipline firms themselves in order to report the information properly. So suppose that all the banks deny the loan. They would correct it immediately. Doesn't make sense. So I'm saying that my debt is different just to get the loan, but all the banks know it, and all the banks check the credit registry. So that's why, in order to have hard information of good quality, in this case, the banks have, especially for small firms, for large firms it's different, but for small firms, the banks have an important, let's say, implication in this.
Do banks cooperate with each other to avoid giving a loan? Like if
They cannot. I mean, this is a very good question. So the way in which they can cooperate, in some sense, is when they check the credit registry, they see who is lending to the firm. But in the credit registry, you don't see the banks. You see the aggregate information, right? So you see that Pescanova has 100 million in loans and is paying all the loans, but I don't know who is lending. So, I mean, of course, at the low level, probably if someone discovers this, it's very possible that the bank goes to the other one and says, look, be careful because I have discovered this, right? At the low level. But, I mean, the banks have a very hierarchical scale. So when you start to go up, and I will explain it later, it's much more difficult, right? That the information is taken seriously at the top of the bank. Or probably there are other incentives that I don't know.
yeah.
Okay, and is it legal if the banks share information of that type, like, for example, big clients who are, complying on the payments?
But suppose that you and I are lending to Pescanova. And I check the credit registry, right? So I check the credit registry and I say, look, the debt in the credit registry is 6 times larger than the one that I see in the financial statements. I'm not going to give the loan. But in order to survive, in order to continue repaying my loans, I want that Pescanova survives. So if Pescanova defaults, it's not going to pay to me and it's not going to pay to you. Do you think that there is a good incentive to me to say, be careful, don't give the loan to them? I didn't, because if you give the loan to them, they are not going to repay you, but also to me. So,
and is it illegal if, for example, if I have a conflict of interest with Pescanova, they own me, and there's a bank, and I intentionally tell them, like, hey, this company is doing really well, is that illegal?
I don't know, probably it is, I don't know.
Maybe it's called a legal gap.
I don't know. With legal things, I don't know. But what I can tell you is that I don't have incentives to tell you that Pescanova is lying, because if you discover it, you are not going to lend to them. And what I prefer is that you continue lending to Pescanova so that Pescanova can repay you. Right? So, I mean, I think that the collusion there is otherwise is that there is a company that doesn't have a relationship with you and with me, and then I say, look, you have an exposure to it? No, don't give them money, right? But it's more difficult. So that's what I was saying. No? On the one hand, the banks play an important role in order to improve the quality of hard data, because they want to have good quality hard data. But on the other hand, this uncertainty about the quality of the firm, that we were saying, is good to me. So I don't want to discover it. Right? Perfect. So the data. This is what we do in the paper. And now you stop me and you ask me what to do, whether the data is public, if not, how can you do it? Because, as I said, at the end of these 2 sessions, what they want you to write a 2 pages project, which you say, look, based on this information that we have seen in the classes, I would like to do a master thesis or a paper on this. And then, which is the data that I need. Of course, you don't have the data, but you can say the letter to the kings that I said, and you can say, look, I want loan level information. I want to see the interest rate, the quantity of the loan, the risk of the loan. And based on that, I would run this regression. With this regression, I would test this hypothesis. And the result that I expect is this one, right? And my contribution to the literature would be that. Okay? So the data that we have, we use here 3 different data sources. So one is the Banco de España Public Credit Registry, the one that I was mentioning here every time. So in this credit registry, I see all the credit exposures of all the Spanish banks to all the Spanish banks. Doesn't matter the size, okay? So if a bank gives a loan to a firm, I see all the characteristics associated to the loan. Every month. Every month, this is updated, right? Perfect. So I can see this. So what I can see from that data set is the size of the loan and the characteristics of the loan. The second data set is called Central de Balances. Central de Balances is just a part of the Banco de España that collects information from the trade registries. So the firms deposit their accounts in the trade registry and they collect all the information and they work with them. So they discover whether they are outliers, whether they are mistakes in the data, they call the company, look, this is not good, this is, right? So this is a very good quality data. We also use information on the bank's balance sheets. So we know the characteristics of the bank, the size of the bank, whether the bank has good capital, low capital, and importantly, there is a data set here that is very interesting that are the request of information. I will explain a lot of things about this because now I can go faster. What is this? The data set number 4. Request for information are requests on the credit situation of the company. This is this. So the bank calls the credit registry and the bank says, look, I have received a loan application from this firm. How is the situation of this firm? So I don't know whether the loan was granted. Well, if the loan is granted, I know it. But I don't know whether the loan was rejected or whether the bank gave a loan to the company without considering the credit register. That is a request of information. I know when the bank requests the information to the Banco de España. There are some cases of some, I'm not going to say the name of the banks, but there were some banks that wanted to create their own FICO, let's say their own credit bureau, no? And they were asking to the Banco de España about many companies, but these companies never asked for a loan. And this bank was fine, okay? So I see this. When a bank has a relationship with a firm, Banco de España sends information every month on the historical of the loans and the ability of the firm to pay the loans during the last 6 months.
So there's a lot of information, or is immediate? Because, for instance, let's say I have a company and I'm not over leveraged. Let's say I have a profit ratio EBITDA that's less than 4. Okay. So then, because this has happened in the States where you're healthy, balance sheet wise, and then all of a sudden you ask all loans at the same time. And since those banks takes a little bit to report that to the agency, the other banks don't know until that's updated. And at that point, I already have all the loans in my pocket, and then at that point I'm over leveraged because I ask all at the same time, and I already have all the money, and then they cannot do anything about it.
It could happen in the sense that the information here has a given delay, in the sense that it's not updated on a daily basis. It's updated manually. So it has a given delay. So this is an example of a question that you can say, look, I want to answer this. So in that case, your paper would be, I want to see whether firms that are very solvent, when they have liquidity needs or they have an investment need or whatever, if they ask information, is here, somehow is here, I will explain you here. And then I ask to several banks at the same time. And this is what these firms do. The firms that we report, this is what they do. They go to several banks at the same time. Because probably one of them does not check this and give me the loan. So firms are doing it. but because of misreporting, because I misreport and I do this. Another theory is the one that you propose that makes a lot of sense. So my leverage is very low. If they see my situation at the Banco de España is nice, my leverage is low, I need a lot of money, no bank is going to give me this, and then I apply to many banks. This is in some sense what traders do in financial markets. When they have good information, they don't say, I want to buy 1,000 stocks. What they do is to buy the stocks in several blocks, such that nobody sees that there is someone in the market. Look, Alex is buying 1,000 stocks. I mean, he has some information. On the contrary, if you buy 10, over time, people probably don't check this. Right? So this matters, of course. But this is a good thing to check, for instance. Yeah.
Yeah, I wanted to add to like Alex's point, which is like very interesting. At least for the real estate side, when you're applying for a loan, a mortgage loan in the bank, they ask you to go to the portal of CIBIL and you download this like certificate where it's like all your like loans and stuff. But like I had like one real estate professor who gave us a trick, which I'm not gonna mention his name. He told us if you're trying to buy a house on a mortgage, you can go to the portal, do the certification, ask for a loan, and then you can still like ask for another loan like within a week, because like it takes like some time for that loan to be reflected. So it's just
Firms do this, and this is very important. I don't know. I mean, if you want to stop here, we can continue. You want break or?
Yes.
Okay, sorry, because I started just this because this is very important. Otherwise, I forget. You know that in the United States, I mean, this data set is for free. You can use it, right, for your master thesis or whatever. So it's good because we have ideas, and then it's HAMDA, the name of the data set. HAMDA. It is probably it's not written like that, but I think it's MDA or HDMA. I don't remember. So this is very important. So in this data set, you have all the individual mortgages granted in the United States, millions and millions of mortgages. And you not only have the mortgage, you have also the applications of the households. And this is very important. And I use it. So in this data set, it was created to see that banks were treating households equally, in the sense that, look, there is not a bias. Look, this person comes from Spain, I'm going to loan to the persons that come from Spain, right? And it is this. So in this data set, you have information about the age, about the nationality, about many different factors. So what happens here is exactly what you were saying. So in this data set, in the request for information and here, it's very common that a firm applies to 3 banks at the same time. Because I want to optimize. I mean, when you buy a house, you will see that you don't go to a bank, you go to several banks. Because you can see that some have better or worse conditions. The point is, if you see the Banco de España data set, you don't see whether the loan is rejected. You see that the loan was not granted, but you don't see whether it's a rejection or not. In this data set, you can see whether the mortgage is rejected. And there is a paper using this data that shows exactly what you were saying. So it's not that the bank is not giving me the loan. It's that I applied to several banks. Probably all the banks accept my application, but they choose the one that is better to me, with the lower interest rate, with a higher size, and so on.
So you just see if someone, like here in Spain, you just see if someone applies, but not if we were rejected.
We just see whether the bank asks for information to the Banco de España about that firm. What happens? If the bank has a relationship with the firm, Banco de España sends the information. So it could be the case that the firm applies to a bank in which I have a previous loan, the bank rejects my application, and I don't see that this is a rejection, because I don't see what happens there. And it could be the case that, your name, sorry? Hanan. What Hanan was saying is that it could be the case that I applied to 3 banks, 2 reject the application, and 1 no. Or it could be the case that the 3 accept the application, but then I decide. And this is what happens in the US, and this paper, based on this data set, so does, in the sense that households apply to many, and I cannot say that this is a rejection. What I can say is that the household is the one that decides the loan that he or she wants. That's it. Okay? So these are the data sets. But ask me because, I mean, you asked me and I give you some ideas about data sets that you can check for your master thesis. You have millions and millions of data. You have information on where the household is located, whether in the county or the zip code in which they live. So it's, and also, I think the bank that is granting the loan, right? So we stop here. 10 minutes is fine, or? The European Banking Authority, they have also some data formats. I mean, there are data, right? If you use data, you have sources of data. Okay, so how do we define the misreporting? How can we measure whether a firm is willing to lie to the bank or not, or is providing information for us? So what we do is, we just take the difference between the bank debt that the firm is reporting the financial statements. So this is the information that the firm has. So I say that my loans are 100. And we compare this information with the one that we have in the credit register. It should be the same, right? Because it's bank debt. So there is one thing that I didn't mention, and nobody mentions in the paper, that makes that this is not perfect. And of course, I mean, we do that relative to total assets, okay? So what you have in the denominator are the total assets of the firm. Because, I mean, if you, suppose that you are running a regression and you want to use, I don't know, I'm going to use the total assets of the firm, or the total debt of the firm. So if you don't scale by the total assets, what you are measuring in all these variables is what? Is the size of the firm, no? So suppose that you run a regression, the dependent variable is the total assets, and the explanatory variable is whatever, the earnings or the total debt. And then you don't scale and you get a very good adjustment, but it's not because the debt or the earnings predict perfectly the total assets, it's because the scale, right? So it's just that. That's why in this variable we take the bank debt that we observe in the financial statements. So the first part, the CV, is the information that the firm report to the trade registry, and the second part, theory, is the information on the same variable, the loans that the banks report to the Bank of Spain. And then we can see who is lying. I mean, we don't know who is lying because if they say different things, who do you believe? I believe the trade registry because the banks are saying that the EA is the total assets. So we scale by the size of the firm. Okay? And then this is in relative terms. So the difference is 1% of total assets, 10% of total assets, because as I was saying, if not, I'm just taking into account the difference. Suppose that you have a firm that has 10 million euros and the other that has 600. That's it. Right? So it's very important. When you run a regression using accounting ratios or whatever, it's very important to understand that. So the difference is that the information that you have in the financial statements that the firms report contains all the bank debt. So if a foreign bank is lending to the firm, it's there. But the information that we have in the credit history contains information on the loans that are granted by Spanish banks. Okay? So for big corporations, suppose that you have a bank in the UK that is lending to the firms, they are not going to coincide. They are going to be different. Okay? But that's the idea. So we have underreporting. What does underreporting mean? Underreporting means that this is negative, right? So if there is underreporting, it means that the information that the firm is reporting to the trade registry is lower than the amount of debt that the bank is reporting on that bank to the Bank of Spain. So even when we see that we don't have information on foreign banks, the bias goes against us. So it could be even larger than the dimension. And we have over-reporting when the information that the firm is reporting to the trade registry is larger than the one that is, the information that the firm is reporting in the financial statements is higher than the one that the banks are reporting. And it should be because of a typo or a mistake problem with the firm, not because the firm is willing to say, look, I have more debt. Okay? And then we use two dummies to say, look, high underreporting. You know what a dummy variable is, one indicator variable. High underreporting is equal to 1 when this ratio is above 10%. So important. I'm referring there to standard loans. Standard loans is something that is very easy to measure, right? I mean, what is the loan that you have with the bank? So we are removing leasing, factoring, all the loans that could be, let's say, difficult to take into account in accounting terms. But we also measure, let's say, using the total debt. So I'm going to use all the loans. Doesn't matter whether they are leasing, they are factoring, all of them. Okay. So what happens? That I'm going to show you the incentives of the firms to this report and the bank's reaction to this reporting. First thing, what we observe. I'm showing you the example. Okay, so the bank relationships is important for the banks, no? What I was saying. So the downside is, okay, so banks want to have, this is the same as before, good data on the firms, but on the other hand, if I know that the firm is not reporting properly, what you said before, I not going to say anything to the other clients. No? Our point is that banks are able to improve hard information, hard data, because they can do it in two ways. First, they restrict the credit to the firms that are misreporting. Oh, you are lying? I know we leave you alone. If all the banks do the same, firms are going to report the information perfectly. And the other thing is that, as I was saying, if the firm is fine, I don't have an incentive to class, but in some cases the economic cost for the firm is very low. Because suppose I'm a small firm, I'm asking for a loan of 10,000 euros and the bank says, look, I know that you are trying to lie to me, but what is the cost to me in order to go a lawyer and take this? They don't do it. So this figure is the one that summarizes the paper. This is very nice. So you see here, you know what this is, not the Instagram. This is the plot, like the kernel. You can do the kernel, which is nice, but I want to do that histogram here. So in the vertical axis, you have the percentages of cases in each category, in which the horizontal axis, the X, is the debt reported to the credit registry versus the debt reported to the financial state. So now it's the opposite that I said in the right? But it's the same, relative to total assets. So in these bars that you see in black, do you think that they are symmetric or asymmetric?
It's skewed to the right, no?
To the right. And what happens with the red ones? There is no skewness there, no? The red ones are the firms that are not financially constrained.
What do you see?
Financially constrained, good question. Three things. They have higher financial needs, which means that they have a lot of debt that is maturing in the short term. So you have a loan that you have to repay to the bank in 3 months. Second, they have more liquidity constraints. That is the same in the sense that they have to finance some projects. Financing needs is also measured depending on whether they are applying to a bank or not for a loan. Right? So look, I know that I need a loan, and I know whether I am applying to a bank. So if I apply to a bank, if I have a lot of debt that is maturing in the short term, and the cost of capital, that is the cost of my debt, is very high, then I'm financially constrained.
Like riskier companies.
You can consider them like risky, of course, but risky that also apply for a loan. I mean, firms that are financially constrained are usually small, risky, younger. But the point is that these firms, the ones that are in the black boxes, these are the ones that are going to apply for a loan because I need money. So in many cases, they are risky. The other ones are the ones that are not financially constrained. And you see who is to the, as you said, skewed to the right, the ones that need money. So it's not random. I mean, if this, because at the beginning people told us, look, what you are finding in the paper is something that is random. I mean, firms they are not able to report their financial statements properly, blah blah blah. But with this figure, you are done. I mean, this is a paper, right? In many cases, a paper is a figure. Nobody can tell you that this is. I mean, what? I'm showing you the red line, and it's totally symmetric. And look, the red line is focused where? At zero. Look at the proportion of companies with no misreporting when it's red, when they don't have financial constraints. They say the same number, exactly the same number in the two cases. Right?
Professor, what's the conclusion of this graph? That companies, the riskier companies, as I call them, have
financially constrained. Let's say you're right. They are riskier, but they are the ones that are financially constrained. The ones that are more likely to apply for a new loan, they underreport the debt in the financial statements.
they are more probable that they underreport their debt because they need money.
Exactly. Okay, so the next thing that we are going to do, the regression. So you have studied the panel data, no? Okay, so here what we have is a regression analysis that is very simple. This is the baseline. So we want to see this, and this is something very important. I mean, when you sell a paper or when you run an interview or whatever, don't talk about causality, right? I mean, causality is something that nowadays is very serious and you need to do a lot of tests in order to show that something is causal. So just refer to correlation, right? So when you run a regression, a panel regression, you always write. So the impact of this is black. I mean, you are saying that this is causal. You are saying that this has an impact on this, but it's probably just a correlation, right? Okay, so here, this is a panel data regression in which the dependent variable is all the proxies related to under-recording, so all the variables that I was showing you here, this one, the 3 ones, okay? And the variable of interest are the one that measure the financial mistakes. The first one is applications. You see, they are at the same period, time t and time t, and you will see why I changed it later. So application is a dummy that is equal to 1 if the firm is applying this year to any bank. I don't care where. I know that the firm needs money because they are applying to a bank. The variable short-term credit is the proportion of short-term credit relative to total credit. So I have a paper in which I show that when it's above 25%, the probability that this firm apply for a loan is very high. So suppose that you have 100 million of credit, and this year matures 80 million. It's very probable that you need to continue. No? And financial expenditures is the cost of the money that you have. So the larger it is, the more probable is that I try to get a new loan that is cheaper. No? Fine. And then we have a lot of controls. You see, in controls, it's a firm time, so I'm using the firm controls. So the fixed effects, what are the fixed effects that I'm using? You know what the fixed effect is, no?
You repeat.
The fixed effects are I don't know how to see, I don't have a pointer. No? You see, I'm very bad for the Greek letters. You have to help me. You see the epsilon, the last one? This is the noise, no? Of the regression. So this is what we are not able to estimate. Then you have the mu that have a subscript of t, but this is the fixed effect at time level. And then you have the other one, this Greek, someone tell me the name of it. It's called whatever. Okay. You see the subscript a, this is the fixed effect at the time level. So when we use fixed effects, what we are doing is to remove the average and the reporting for a given firm for a given time. So when you use, for instance, you go to this data, no, it's like that. Exactly, it's like that. So it's
In the data model,
exactly.
you
It's
take
the,
alpha I and alpha B.
you have this is the firm time. We have the beta, the control variables, and then you have the u1 to alpha equal to alpha and time plus the epsilon firm time. Okay. So when you run this in the Stata, there is a command that is called red high dimension fixed effect, and this is the best thing that I've seen in my life in Stata. Because here you can specify all the fixed effects that you want to use. So in this case we have millions of firms. You don't need to write millions of dummies. Right? You use this, you put here the dependent variable, the explanatory variable, and then you write absorb, and here you write the fixed effects. The firm fixed effect, and then times the time fixed effect. Be careful with the fixed effect. Because there was this is true, there was a candidate that did a PhD in Harvard or one of these top universities in the US. And he had the paper with fixed effects and it was wrong. Right? So the fixed effect is not that I have a variable, suppose that this is the firm. And then I have the number of the firm, right? And this is a panel. So I have firm 1 that appears in here with the firm 2, blah, 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 up to firm, I don't know, 1 million. So in his paper, when he ran the regression in Stata, he was using the logarithm of this. So the fixed effect doesn't mean that you use this variable like that and you put it in the regression. The fixed effect means If I have 1.2 million of observations, it means that you have 1 to 2 million of variables, right? So you have in this case it would be, okay, so the fixed effect for firm 1, it could be 1, 1, and then 0. The fixed effect for firm 2, it could be 0, 0, 1, 1, and then 0. And the same for the other. Okay, so the fixed effect means that you are using a dummy that is 1 for that firm and 0 for the rest. But if you have 1.2 million of observations, you have 1 to 2 million of dummy variables. Okay, so with this command, you have everything to it. Okay, so there was a question that was very nice. I mean, this guy, what he did is to use the logarithm of the, you can see it in the, of the sector. Of the, the sector is called NACE, or in Spanish is NAI, no? It's the código de nacional. So he was taking the logarithm of this. You know, the NAI has like 4 digits, and he was taking the logarithm of that. So it's equivalent to say, yeah, look, I'm going to put this in the relation. No, it's not that. Okay? I say this because, again, it was a candidate from Harvard, or I don't remember from where, and he said that he had fixed effects at the sector level, and it's not that he had, I don't know, 10,000 dummies for the sector. He took the logarithm of the number of the sector. Okay? And with this command, you can do that. What the fixed effect is doing here is just to take the average news reporting within firm or within time across all the firms. So it's just to take out the average. That's the fixed effect, right? So if you want a regression, and here you want to write the fixed effect for the firm 1, and you go to the coefficient that you estimate for the firm 1 is the average news reporting of that firm. So when we use here firm fixed effects, it means that we are analyzing within that firm, how is reporting evolves when the need of financing increases. Okay? That's the idea. If I don't use firm fixed effects, suppose that I don't use firm fixed effects, I would be relating the pool, all the firms, how they react in terms of underreporting when the financing need increases. But it's not within a given firm. Okay, you see the difference, no? With the fixed effects. Okay.
Professor, when doing what we have to use fixed effects.
It depends on what you want to check. Suppose that in this case, what is of interest for you? You want to see the relationship between the short-term credit or underreporting, or you want to see what happens within a specific firm when the financing need increases? It's different, because the other thing could be just driven by the correlation that you have in a given time. It's true that you are using fixed effects, no? But it could be driven by, let's say, a group of firms have more needs of credit and they underreport. But it could be a different firm. Right? When you use here firm fixed effects, is that you are saying within that firm tells me what happens when they increase the need of financing. That's where you see the within and the across. No? That's the difference. So if you want to see the cross section, so if you don't write these firm fixed effects, it's just you are using a pool. So it could be that, I don't know, the relationship is in one period or the other. But it's not within the same firm all the time. So if I don't use firm fixed effects, it's like using like a cross-sectional relation. So I'm putting during the whole period that they have what happens with these two variables, and they are correlating, fine. But what matters to me is that it's within the firm. Okay, so sometimes, I will show you more examples of this. This is a very good question. When you run a regression in which you have information at the bank firm level, time, there you use firm time fixed effect for what? In order to remove the average demand of credit of the firm across banks. And you want to focus on the supply of a specific bank to the firm. Right? So it depends on the specification, but this is very important, and every time that you have regression, ask to me, because there are two things that are very important here. One is how to use the fixed effects in the panel data, and the other, the level of clustering. Have you learned about the cluster standard errors? Do you know what is that? Okay. So the coefficients that I'm estimating here are the coefficients when I take into account what is happening in the epsilon. The epsilon is the residual, right? And what matters here is what is the correlation that I have in the residual within a given firm over time, and the correlation across all the firms in a given period. So if I don't use clusters, if I don't correct the standard errors, what you observe here is 0.024, the standard errors of derivation is going to be wrong. So it does not affect to the coefficient, okay? So what happens with the standard errors, if I take one weak cluster, 2 weak cluster, it does not affect to the coefficient that they use. The other thing is that it estimates it affects to the significance of the coefficient. So if I don't consider the standard errors properly, I'm going to tell you that the coefficient is significant, and probably it's not, because I'm not taking all the correlations that exist in the residuals in the cross section and within a given firm over time. That's why here we are using clusters at the firm level, which means that the reporting of the firm could be persistent. So what happens today is also related to what happened yesterday. This is correlating. And second, during a period of crisis, probably all the firms or many firms are misreporting, and you have to take into account these interresiduals, because otherwise this 0.024 that you see there is wrong, and the stats that they have there are wrong. Right? So the most common thing is when you have a regression at the firm time level, the most common thing is to use two-week clusters. You use clusters at the firm level, which means that you take into account the autocorrelation within the firm, and you take cluster at the time level, which means that there is autocorrelation across time. Right? That's the advice, that's the most general thing. Okay, when you run regulation. Okay, so the coefficients, what are the coefficients telling us? What happens with the application, the short-term rate, and the financial spending? All are positive and significant, which means that the firms that apply to new credit, the firms that have more credit that is maturing in the short term, or the firms that have more financial expenditures, are underreporting. This is the same. I have some in the figure, but with numbers. Okay? So it's not random. With this, the first thing that they can say is that it's not random. It's not that the firms are misreporting because they don't know what they are doing. The firms that need money, they are the ones that are misreporting. And this is related to what Alex was saying, but not related to the amount of data they have, but to the amount of data they want to obtain because they are in a bad situation. So what they do is, the firms that report could obtain credit from banks to which they don't have previous relationships. So if the bank knows me, and the bank is taking it seriously, the bank will be taking the financial statements and the debt over time. So what I want to do here is to check now whether the firms are more likely to ask for a loan in banks that don't know them. And the key here is probably the banks are not checking the financial statements. Right? So it's like if you ask money to your parents. I mean, and your mom tells you no, you are not going to tell your father that your mom told you no. I mean, you try again with your father just to see whether at least that's what they did. But you don't say anything. So you go to a new lender in order to see whether they give you money. Right? So what we do here is we use as a sample of firms. So we are going to use firms that apply for an additional credit to a new bank. Right? So new bank, maybe they have a relationship with them. And firms whose credit increases. And what we want to check here is whether it's more probable that the firms are applying to new banks. So in this regression, the dependent variable is again at the firm time level. So it's equal to 1 if the firm applies to a new bank. And then we use the information on underreporting. But what is the difference here? We are using underreporting lag quantity. I don't want to say anything about causality here. But when you lag the variable, you want to explain what is happening in the future depending on what you have today. So here is, look, the firm is underreporting the year before. What happens the year after? Because I mean, it's not that the banks can see the financial statements of the firms immediately. This is what you said, no? So probably I can try to apply now that I have the old statements in which the debt is wrong. Let's see what I report in the future, but there is a typo, let's say underreporting in the financial statement the year before.
So what about the capacity against that issue? Because I mean, from experience, like I have worked in companies where at the end of the year we will clean
Yeah.
our facilities and then ask for debt increments like double, and you will see on the financial statements that we're gonna leverage, even though we have the debt capacity because we already have the Volvo approved monies.
Your question means that the underreported debt could be interactive. This is something that I'm not doing here. No? In this relation, what is the dependent variable? The dependent variable is with the firm apply, firm F apply, or I, let's say, in times B. And the variable of interest is this underreporting, no? And for firm I times T minus 1. So what you are saying can be very easily tested. This is something that we didn't do because we are controlling by firm fixed effects. It means again, if we are controlling by firm fixed effects, that we are comparing the same firm over time. You will see later that there is another way to do it even better when we use firm bank time information. But in this case, so the way to test what you are saying is, I interact this variable under reporting with another variable that is, let's say, the leverage, no? For instance, the leverage of firm I times T minus 1. Plus, I also have to report this. I mean, this is a good example, right? So what Alex is saying is, here you are reporting the average effect for a given firm. So what I'm going to see here is, if the firm underreported the debt a year ago, it's more likely that they are applying for a new loan the year after, or not?
We expect that it's more probable that they apply for a new loan.
Because we have seen in the previous video that they do that when they need money. But the point of Alex is, in that regression, what I'm estimating, I mean, I don't care if we spend 20 minutes here. I want that you understand the regression, that you understand how to do empirical mapping. So I don't care about the material that we cover, okay? So what Alex is saying is very important. So in that regression, we are obtaining the effect for the underreporting. For the average firm example. Doesn't matter. This is the coefficient that I obtain for the average firm example. What Alex is saying is, but it could be different depending on what the firms have out of leverage or what the firms have lower leverage. It's true that the leverage in some sense, as Jesus said, is implicit in the reporting because the reported firms are worse. Okay? But assume that they are not worse, that they just underreport because they want to obtain new money. If you want to see what you are suggesting, then you need to interact. This is the one, this is the two. You need to interact the variable and the reporting times the leverage. It's the same regression. And what is telling us? Suppose that this is, instead of leverage, high leverage. Okay, this is a down. Is equal to 1 if the firm has like high leverage, and 0 if it has low leverage. What is this telling me?
Marginal effect of high leverage or underreporting.
This one, right? Firm with high leverage. And this one?
The average firm underreporting.
But higher growth. This one, without interaction, is telling me the average effect of the reporting of a low leverage firm. And this one is telling me the marginal effect associated to a firm with high leverage. Okay? So if I want to obtain the effect for a firm with low leverage associated to underreporting, then I need to use this. But if I want to obtain the average effect associated to a firm with high leverage, which is the one that I should use?
Both.
The interaction.
The interaction is here. Is the sum? No? You were saying the sum. No? Because interaction is here. Interaction is the marginal effect, is the differential effect. Okay? It tells you the difference. What happens if this is positive and significant?
There's heterogeneity.
Exactly, but it means that
High leverage firms are more probable to apply to a
Report.
as compared to
low leverage.
exactly. But this is the differential effect. Okay? If you want to see the total effect, you need to take into account the sum of the two coefficients. Okay? And in that way, we split the two. I don't expect a strong effect because, again, and the reporting is going to be correlated with that. I'm using firm fixed effects. So I'm doing it within the firm. So it's not that the leverage of the firm changes a lot. So if the firm suppose that have a flat leverage, the effect associated to the leverage itself is going to be zero. Because I'm using firm fixed effects, okay?
Could you explain again why for robustness check we use the logarithm number?
The second, this
Yeah,
column-
why do we use the
Okay. I'm going there. So I was explaining just this, okay? So here we have two variables for underreported debt or high underreported debt. You remember, this is the ratio, underreported debt, and high underreported debt is a term that is equal to 1 if it is above 10%. So your question is very important. Why I'm using these two columns here? Because of the question that Alex had at the beginning. So it's not that you're applying to a new bank, fine, you're applying to a new bank, but are you applying to more than one bank? And here, in columns 3 and 4, the dependent variable is the logarithm of the number of new banks to which the firm is applying. Okay? So it's not just that I'm applying to a new bank, it's to how many banks I'm applying. And what you observe is that when you use the logarithm, it's also positive and significant. So they misreport because they need money, they go to a new bank, so I come here, they don't know me, let's see if they don't check the financial statements. And I'm not going to one bank, I go to several banks to see if one of them hopefully is giving me the money.
I see, for example, in the high underreported debt, it has a lower coefficient.
Perfect, fine. But I mean, don't interpret the coefficients directly, because in order to interpret the coefficients, you need to understand the units in which the variables are defined. So this is different. And the reported debt is a ratio. I mean, the police are giving the money a lot because I'm going to explain you more. So this is a very good question. So in the first column, underreported debt is a ratio. So it's the amount of debt that is underreported relative to total assets. And in the second column is a dummy variable. So you cannot mix coefficients. I mean, never mix coefficients, even if you are using the same variable, the same dependent variable, or the same measure of leverage. If the samples are not the same, don't compare coefficients. If you want to compare coefficients, it's like the question by Alex. So suppose that I want to compare coefficients. I'm not going to run two separate regressions. One is for the sample of low leverage, and the other is for the sample of high leverage. And then I compare the coefficients. And I use that specification. No. Use one specification, use interaction, and then see whether the interactions are significant or not. But don't split the data, because if you split the data, you lose power. Right? Sometimes people do that, but they don't do that because it's better. They do that because it's the way in which they can play a little bit. This is 0.5 and the other is 0.6. It's larger. No, show me that it's significantly larger. And the only way to show that it's significantly larger is to use one single regression with interactions. Okay? This is one thing. So the second, here, I mean, the variables are also different. So this is a ratio. So if you want to compare the two, you can do something that is called semi-elasticity, okay? Semi-elasticity is I take the coefficient that I have estimated, black, I multiply this times, this is the 0.047. I multiply this times the average of the variable x, right? And then I divide this by the average of the dependent variable. Right? Because this refers to the unit of x, and the dependent variable is the same. So if you do that, you can in some sense compare whether it's higher or lower, but the variables are different. Right? So semi-elasticity means that you don't compare the direct elasticity, you multiply the coefficient times the variable x, and you put it relative to the dependent variable. And then you can compare across columns. So the three of the low leverage and high leverage. Suppose that I run separate regressions, and I want to compare what happens with low versus high. I cannot compare the coefficients directly. The only way, which is not perfect, is I multiply the coefficient times the average, and I divide it by the average of the dependent variable. If it's negative, you can use the standard deviation. Okay, that's fine. So suppose that this is not the case. No, it's 1 or 0. But suppose that it's negative, there are many people that use the standard deviation.
And the interaction, we can do a single regression with interaction, no?
Say again?
we can also do that regression interaction.
Yeah.
And we can compare as well.
If you do this in the same regression, you can see whether this is significant or not.
With the same sample. But we cannot compare the coefficients. We use
No, I mean, if you do this, you can see whether this coefficient is statistically significant or not. And that's fine, that's perfect. What I mean is, if you split the regression into high leverage and low leverage, if the variable under reporting is different for high leverage and low leverage is going to be different, I tell you, you cannot compare the coefficients because the variables are different. And then you have to standardize in this way. And then you can compare the semi-elasticities. But the best way is this, to put interaction. You can add up to 3 interactions. 3 interactions is a lot. There are people that don't like because it's difficult to compare 3 interactions. You need to go one by one. Okay? And sometimes it's not difficult to get the effect.
sorry, I want to understand.
Yeah.
100%. So in that regression we wrote, we cannot
This one.
compare. We need the interaction. Can we compare the coefficients?
Yeah.
The theta or whatever one with the delta two.
No, they are different. I mean, they are different. So these two, this delta 2, I'm saying delta, because this delta 2 tells you the differential effect of underreporting on the probability of apply. This is the differential effect of high leverage firms as compared to low leverage firms.
Okay, but we can compare the theta 1 with the theta 1 plus theta 2.
With this, you see the average, the effect for the low and the high.
And that we can compare that.
In order to compare that, you need to play a little bit with the standard errors, but you can. There are some, in this data for instance, there is something that is called mean com, and then you write this one plus this one, and then you can see whether the combination of the two is statistically significant, and then you can compare. With this Lincoln command, you can compare the coefficients that you want, right? But again, I mean, suppose that this is significant, okay? Suppose that this is significant. The effect on low leverage firm is significant. This one is also significant. We are going to say that, of course, I mean, for the high leverage firms, it's not significant. You don't need to do anything. Okay? The only thing is that this gives you the differential effect of high leverage over low leverage, and the sum of the two tells you the total effect for the high leverage, whereas this one tells you the total effect for the low leverage. Okay? More complicated. Do banks react to this reporting? How can you see whether banks react to the quality of hard data? What is the action of, what is what firms are trying to obtain? Credit, no? How can you do it? You can see whether banks are really lending to firms that compare. This is what we are doing now. So, this is the upside and the downside, and what we want to see here is whether banks react to underreporting, penalizing firms cutting credit. Okay? So I see that in this report, I am going to give you my sorry. It means that firms, in some sense, will react to that. And this is
So, I understand, you don't give them the loan. So then, is there any studies or anything that we could say, okay, it has a positive effect that the firm could, on the reports on year 1, now that it was penalized with no getting out of loan, will start reporting correctly on year 2?
yeah, I'm going to show this. This is the last part. This is the last part of the story. I mean, when I always, I mean, sometimes I am not able to do it, but when I write a paper, I take to do like a story, whole story. No? So the first thing is that firms lie. Do banks see? Yes, they do. And the last thing is, does it affect the firms? So do they react? And this is the last thing that we want to see. But first of all, I want to see whether banks really take it seriously and banks really try to deceive firms. And then the relation here is different. I mean, stop me whenever you want, ask me to go back. Here we are using a regression to study bank supply. And this is a very well-known regression, and many people use this methodology nowadays in the digital bank. So, the dependent variable is the log change in credit. Okay?
Change in credit of a pool of the total loan supply to banks.
Look, I take the logarithm of credit of firm F
Okay,
in bank B times T with a trig plus 1, which is the logarithm of something that is 0. So if I do not add 1 here, when this is equal to 0, I'm not going to consider this firm. So it means that firms that have credit a year ago and today don't have credit are going to be removed from my equation. There are many people that do this mistake. Okay? Minus the logarithm of credit of the same firm in the same bank at time t minus 1, the year before, plus 1. This is the opposite. So suppose that the firm has here 0 credit. I cannot use this firm. So all the firms that didn't have credit and suddenly have credit are not used. It's true that this is misreporting, so they misreport is because they have credit. But in all these regressions, this is very important. There are people that don't like it. What is the problem of using this dependent variable? So suppose that this is 0, the logarithm of 1 is 0. But if here they have something positive, if we try to translate this into percentages, it could be 700%. Which means that there are a lot of outliers. And if you do this in the data, you will see that in many cases it's between minus 11 and plus 11. So minus 1,100%. So there are many people that when they run this regression, they use the credit of the firm at bank minus the credit of the firm at bank B times 1 over the average of the two. Okay, so if I write here the average credit FBT plus credit FBT minus 1, this is going to be between minus 2 and 2. I mean, still you have minus 200%. If this is 0, the average is going to be not that up, so it's 2 times that. So there are many people that prefer to do it. So the dependent variable is the change in credit granted by a given bank B to a firm F at time T. This is the delta, okay? The logarithm. Look, the first variable is at the bank level. And what is that? Is the bank exposure to underreporting a year before. Not just to the firm that underreports. I mean, it's the total exposure of the banks to underreporting. The translation in Spanish would be the prestadas, no? Because I'm very exposed to that. So that's the point. So it's not that I'm lending to you that are misreporting, it's that I'm lending to many firms and they are underreporters. And then it goes to the interaction that we have seen before. You see, everything is connected. The second is the bank exposure to underreporting a year before interacted with a dummy that is equal to 1 if the firm is underreported. Let me go back to what we have learned before about the interaction. What is giving me the first variable, the bank exposure? This delta 1. What is telling me?
It's the effect on the change in credit
Exactly.
of that was exposed to leverage in the past, the year before.
Yeah, if the firm doesn't underreport. And the second one is, which is the, let's say delta, I don't know. I'm very bad for the Greeks. The one, let's say delta 2, no? Delta 2 is the bank exposure to underreporting times the underreported debt. This is giving me what? The differential effect.
For the underreported loans.
Exactly. Okay? And if I want to see the total effect for the firms that underreport, I have to sum the first and the second. Okay? Fine. This is very important. Here I can use fixed effects at the, controls at the firm level, and I use fixed effects at the bank level. So when I use fixed effects at the bank level here, you see this big B, I know this big, this big B, it tells you the average amount of credit offered by the bank. So you are seeing the evolution. I mean, you take the bank and you take characteristics. For instance, can I use a dummy variable that is equal to 1 if the bank is a cooperative of credit or a commercial bank if I use bank fixed effects? No, because it gives it. Right? So with this bigger B, it means that I cannot use any band characteristic that is fixed over time because it fixed. The fixed effect is giving me that. It's giving the average effect associated to that band. So suppose that, look, I'm going to use a dummy variable to see whether the bank is a cooperative. Don't use it because you are not going to estimate it. And the most important of this regression is the first researcher that did this with was Guayamian. I don't know if you have heard this about some seminars, Guayamian. I don't know the name because I don't know how to write Guaya, but it's Guayamian, right? Mian, yes. Mian is, and Guaya is K, what? Something like, I don't know, like Guaya. It's a Guayamian. What they did is, the change in credit can be driven by supply or demand, right? And I'm interested in the supply of credit. How can I control by demand? If I use firm time fixed effects, you see, the IT, new IT, if I use firm time fixed effects, it means that I'm considering the fixed demand of the firm across all the banks. So the assumption here is that when the firm demands credit in a given year, they are going to demand the same to all the banks. That's why I use firm time fixed effects. When in the previous regression in which I was using firm fixed effects, I told you within the firm what happens with the applications or the underreporting when the firm increases the amount of short-term debt or when the firm applies for a loan. In this regression, we are using firm time fixed effects, which means that I'm considering the fixed demand of the firm in a given year across all the banks. And the coefficients of delta 1 and delta 2 are giving me the supply of credit to that firm by two banks that are different in terms of the exposure to underreporting. Okay? So the idea with the fixed effect is that I fix something. In the first regression, firm level, I fix the firm. And I see what happens. When the firm applies to a loan, I see what happens with the probability of underreporting. Here, I'm fixing the firm in a given year. That's why in this regression, I cannot use the variable underreported debt. You see? The coefficients that you see there, we don't have underreported debt of the firm in a given period. Why? Because the fixed effect keeps. Okay, do you see the?
So why is it underreported debt in a given year?
Because the firm fixed effect, suppose the amount of fixed effects that you have here. So you have in the previous one, I was doing many variables referred to the firms that I use. No? One firm, one fixed effect. Here is firm 1, year 1. Firm 2, firm 1, sorry, year 2. Firm 1 or the year that they have. So suppose that this is the year, this is year 1, this is year 2, year 3, and here is 1, 0, 0. This is 0, 1, 0. And the same for all the firms. It means that I'm using all these variables. So what I'm doing is I'm fixing the firm today, in this year, and I'm going to compare two different banks. That's what we are estimating in this regression. So firm I and year 1. And I see how two different banks are lending to the same firm. And that's why I can identify supply, because the difference between the two banks is the exposure to underreporting. And then I can say, two different banks would supply credit to the same firm differently, depending on whether they are more or less exposed to underreporting. That's the magic thing about these fixed effects. It's not perfect. The assumption is that firms demand credit to the banks in the same way. So if we consider that a firm knows a bank better, probably the demand is different, right? And this doesn't work. And there is a lot of new papers now that are trying to kill this way. But it's like the CAPM, the CAPM model in finance. I mean, people hate it, there are many people, but people still use it, right? So this is the same idea. And this is the most important specification in banking in order to study anything. This one, right? So firm time fixed effects, I kill demand. So nobody can tell me, but people can tell you, I told you there are many papers on that. But with this, I'm fixing demand and I'm seeing what happens in terms of supply. Okay? I remember there was someone got the data from the banco, the credit register, and he told me, look, I'm working with that 6 months and it's impossible to run a relay. Why? Yeah, because you have a limit of time. So in the banco we have 12 hours. After the 12 hours, the laptop pulls you out and then you need to enter again. And the problem is that what you are doing, if it didn't run at that moment, I mean, you have to start from the beginning. And this person didn't know this, again, magic command. Probably you don't remember me because of many things, but believe me that if you do research, you will believe that you will remember this command. It's not mine. It's Sergio Correa, but it's not mine. This person didn't use this command, and what this person was doing is, suppose that you have 1 million of firms. He was defining fixed effects, 1 million of firms, 10 years, so 10 millions of fixed effects. And he spent the 12 hours during a day, defining the fixed effects. So, state in some cases, you are crazy. 10 million of variables, and then I told him, have you tried this? And one day I saw this person, he was 6 months with that. It changed my life, thank you. Sometimes you have to read Copilot, or you need to ask, there are a lot of tools today to see which is the most efficient way in order to run the operation. And they will tell you how, right? I mean, the old school econometrics, forget about it. Many people do code with artificial intelligence. Okay, so the regressions. Here, I'm using back fixed effects. This is the same regression that we see there. So what is saying the first coefficient? Again, I mean the two variables from the reporting, the ratio and the number. What is saying the first column here? The first coefficient. The land and the exposure from the reporting. Is significant?
No, it's not significant.
And what does it mean?
The fact that a bank had a big exposure in the past doesn't affect the credit supply
To
to
what firms?
average credit that asks for credit.
And that's not under report. It makes sense, no? Look, I'm very exposed to firms that under report, but the firm that applies to me is not under reporting. This is what is saying the first coefficient, no? This minus 0.6, whatever. So why should I lend more or less to this firm if I don't consider it just under reporting? I don't lend you more or less because being under reporting. But what is telling you the second coefficient? This one. Is the differential effect, the differential credit supply of banks more exposed to underreporters when the firm is underreported. And what are the banks doing to that firm? They are cutting credit. Okay?
Can you explain the word?
The first one is the same as before. That's why I was using the example that Alex said because it's very useful to me. So the first one is at the bank level. And this is interacting with X, and X is the underreporting. And the first one is telling you which is the supply of credit by a given bank that has a given exposure to underreporting, whatever, to the average firm that does not underreport. And it's not significant. This is what you said, and it was on the exercise. And the second one is, let's interact this with the dummy or the variable that measure whether the firm is underreporting or not. And this is the differential effect, the differential credit supply of the bank that is exposed to the reporting firms if the firm is underreporting. X is equal to 1. And this is negative and significant. And if you want to see the total effect of credit supply to firms that are underreporting, you need to do the sum of this plus. Okay?
Even though the first one is not significant, you can add them.
I mean, you can add them because you will see that the total effect would be even larger, no? I mean, on average it's not significant, but when you take the average of the two, it would be minus 2.3. And in order to see whether it is statistically significant or not, in Stata, you use the command that is called LinCom, that is the linear combination of this. Then you say LinCom, this one plus this one. You write the name of the variable here. And with the Stata tells you the linear combination of the two, the total effect is significant or is not. Okay? Okay, next step. Second point, what happens here? Look, I'm using bank year fixed effect. I was explaining that when you use bank year fixed effects, it kills what? It kills all the variables that are defined at the bank time level. What happens with the bank exposure to underreporting? I cannot estimate there because I'm using fixed effects at the bank time level, so it kills all the variables that are at the bank time level. And again, you see the econometrics is like magic, right? What is this coefficient? It's very similar to what? To the sum of the two coefficients in the first column. Why? Because I'm measuring the total effect of credit to underreporting firms. Okay? You see the difference? I'm using bank time fixed effects, I can do it, but then I cannot estimate the effect of the supply of credit to the firms that are not underreporting. I can estimate just the total effect of this firm, which is roughly the sum of it. And here we are using the other dependent variable, the other explanatory variable, high underreporting debt, which when it's total underreporting above 10% of total assets. And here is the same. You see, this is the effect that we find against significant and negative for the firms that underreport, and this coefficient is roughly the sum of it. Okay? But again, what I want you to learn from this specification is the key is this new ID, which is the fixed effect at the firm time level, which controls by demand. So it's like I have firm I, firm 1, and I'm comparing which is the supply of credit for bank 1 and bank 2 to the same firm. Given that these banks are different because of the exposure to underreported, bank exposure to underreported, suppose that is high, and this is bank exposure to underreported, which is low. And you are comparing the credit supply of two banks that are similar in all dimensions. The only difference in this bank is that one is high exposed to underreported and the other is low exposed. And I see how they supply credit to the same firm. This is why this is supply. If I don't use the front-end fixed effect, I'm comparing the supply of banks high and low exposed to underreported to the average firm, but not to the same firm. That's why this is demand. Because the assumption here is that this firm goes to this bank in the same way that the firm goes to this bank. So they know the I need a loan, and then we compare what happens. Okay? So this specification is very, very, very important. One step forward, and then I will stop that. One step forward. What happens? This is interesting. What happens if we check if the banks use the credit registry or not? So the dependent variable is the same, right? The log change in credit. The difference here is that I know whether the bank called Banco de España to say what happened with this firm. And this is the variable bank figure. It means that the bank calls Banco de España and they say, I want to see what happened with this firm. The debt of this firm, whether they are reporting or whether they are not. The second part is the same, whether the bank calls Banco de España, interacted with the dummy that is equal to 1 in the firm under reports. And again, we are using firm time fixed. So now is one step forward. We are comparing the supply of credit of the same bank to that firm, depending on whether the bank checks the credit registry or not. And what happens? If the bank checks the credit registry for that firm, and the firm is not under reporting, what happens with the credit? No, this is the minimum credit, exactly. But what happens if that firm under reports?
They invest because they know what's happening.
Exactly.
But why in this location and the last location, the high underreported debt is lower than the underreported debt, like the coefficient when
This one?
when the firm,
Yeah.
the coefficient when the firm underreports, it's lower, it's high than when it's.
But you are comparing the coefficients of the two tables.
It's not.
No, but this is different. Wait, because what happens here is in the, don't compare the coefficient coefficients across tables because everything is different.
So I'm saying like at one point, for instance, in that,
Yeah.
or, yeah, 0.2 with 0.1, like why it's lower on 0.1, it should be higher, like reduce more risk if it's high underreported than
in this column, right?
in both columns.
No, but
You cannot compare columns.
No, focus in one. Let's start with this one, then we'll go to the other one. In this one. So, the first one, bank survey, tells you the supply of credit of the bank to affirm that it's not under-reporting when the bank says the credit register. Okay, so look, this firm is doing well, so it's doing well, they are reporting they give more credit. As compared to what? I mean, as compared to a bank that does not check the credit registry. Right? I mean, here what matters is the control category. So the first one has to be interpreted, this is a dummy 0.1. Check the credit registry or not. So the first coefficient, the 0.154, is comparing the credit supply of a bank to a firm with similar characteristics to the same firm, depending on whether the bank checked the credit registry or not. So the first coefficient, let me write it down because this is important. So what are we doing in the first coefficient? We are comparing firm 1, and we are using two banks. So the bank 1 checks the credit registry, black, and the bank 2 does not check the credit registry, black. And the firm is not under record. This is what we are comparing. And what I'm telling you is that for that firm that is not under reporting, the bank that checks the credit registry supply more credit than the banks that don't. Because it has more information. In the minus 0.2444 is the same, but is the differential effect if the firm is under reporting. And then what you observe is that the bank that checks the credit registry on that firm lends less to that firm. So your point is, and you're right, if I sum the two coefficients, here the difference is negative, I'm saying that the firms that under-report obtain less credit, and in the second one, it's not statistically significant. That's your point, if I understood correctly.
I don't know. What I was
Forget that what we said, start from the beginning.
No, but what I was asking is that comparing the two, the model 1 and model 2, comparing model 1 and model 2, if a bank checks Bank of Spain and there is underreporting,
Yeah.
obviously the effect is negative. But then, in the second model, if a bank checks and there is high underreporting, there should be higher,
Okay.
not 0.1, 0.1, but maybe 0.5 or maybe
I
higher.
know, I understand now.
Or
But then, I mean, in that one, the X is the amount of credit that is under-reported. So here, we are not considering whether we are saying that the under-reporting is above 10%. This is a dummy. This is a continuous variable here. So what matters here is the amount that is under-reporting. So suppose that we cannot compare, no? Because there could be non-linearities in the data as well. So in the first one, what matters is the amount of data that is under-reporting. Tells you that. So if they are underreporting by 100% of total assets, so the difference between the two types, the debt where total assets is 100%, then you can compare the coefficient. But the other one is 10%, right? So it's not the same, but the 10% is above 10% is 1, right? So you cannot compare. That's what they say. Don't compare the numbers. And then the last slide, and then we go on. Alex, your point. So firms underreport. Banks see through underreporting, they cut lending. I mean, they check the credit risk, they cut lending even more. So do firms learn from this? In the sense that, are banks good agents in order to improve the quality of hard data? And this is related to the presentation that we were using. And the point is, let's see. So the regression that we are running here is at the firm level, okay? The dependent variable is underreported debt, and we are going to replace this in underreported debt a year before and 2 years before. So if the firm doesn't learn about this, I would expect something that is very close to 1 and very persistent. No? I underreport, doesn't matter what you do with me, I continue underreporting. No? And what you can observe in this regression is that if I don't consider what happened 2 years ago, and I focus on the sum regression, I say that 77% of the firms that underreport correct underreporting a year after. Is 1 minus this. Okay? And if I move 2 years more, they don't underreport. Which means that banks are cutting lending if they see that they are underreporting. So underreporting is a game, but it's not a game that, I mean, you don't do this forever. You see that it's not effective, you stop. I'm going to report information properly. Right? This is what you observe here and what you observe here. And again, I mean, don't compare because this is, again, the ratio and this is the damage. Okay? This is different, but here you can see that roughly is the same. So they correct. There is another regression in the final version of the paper that I forgot to put it here, that is the same regression when the bank checks the credit list. And the correction is even faster. So 90% of the firms, 92% of the firms, in 1 year they correct underreporting when one bank has checked the border. Okay? And then we are done. So the point is, why firms do this? I said it at the beginning. For the firms it's very easy. I underreport. If they check fine, they don't check what happens. The banks are not going to do anything. So it's a game. So I know that the banks is going to receive, nobody is going to do anything. So I underreport and I cross the finger. If they check the credit rates, they fine. If not, probably I get fine. How much? 5 billion per year. 5 billion euros per year is the amount of loans that go to firms that underreport. Which is not a lot. I mean, it's just 1.5% of the total credit that is granted. But this 1.5% goes to firms that underreport. So, I mean, the cost is zero, the benefit exists, no? So the game is IMF. Okay? And why banks do that? I gave you the example. This person in this bank said, I forgot to do this. I will read this. They don't check it. So if I go to the office and they don't check, I'm fine. Okay, so that's what I said. This is the first part. And then I continue tomorrow with this hardware. That's the idea. So I mean the theory, you can see this theory in any review of the literature or whatever. So I want you to understand the theory, but I want you to think about new things, right? I mean, this is something new, and nobody has thought about it. So the idea is that for your master thesis, for what you do, that you try to be very creative, right? So what you have to deliver to me is based on this theory, you can think, okay, so based on that, where do I think that I can write a paper, I can write something that is okay there? And then you start thinking, I would need this data, and then you write the data, I would run this regression, okay? That's what I want you to deliver to me, but just, I mean, to play this.
When do we have to do it?
After tomorrow. And you deliver it to me in 2 weeks or in 4 weeks, whenever it goes to me.
Is that written somewhere? Because I wasn't here when you were explaining that.
I mean, tomorrow I will continue with this. You can check the slides. Maria will give you some codes in Python and Stata. I don't know. And what do you prefer, Python or Stata? Python? Okay. And Stata as well. So probably what she's my wife, so I will ask her to explain it in Stata and you do it in Python. Because last time I was teaching this, last year I was teaching in a master in finance in Madrid, and my mistake is that I was explaining the code in Python in class, and the students were asked to deliver this in Python, and they copied it, they didn't know what they were doing. So probably a good choice is that the class is in Stata, because in the end, I mean, you learn how to program a different language, you think what you are doing, and then you do it in Python. And then Maria will send you the right code in Python so that you can have it at the end of the course. Okay? So this is something that you will have to deliver by the end of March. So probably it's better that you deliver this to me by mid-March or so, because otherwise you're going to have to do things.
So, can you upload like some Word document to explain what
yes,
you need to do?
Yes, I will upload this in the what was the name of the in the add you have the word, but I think that there is not specified the word that you have to do. So one is a practical work, that is the one that we told you that you will do in Python, and this work is